investing money is about looking at expectations. And based on what went on in December, it was pretty clear to me that the market was going to discount the possibility of a rate cut. And there's a good reason for that. I mean, we're still not out of the woods. If we go back to like 1998, when the Federal Reserve went on pause because of global economic pressures affecting the U.S. economy, ultimately they were forced to cut rates because of a financial accident. So I don't think we're out of the woods yet that we could have a financial accident that would cause the Fed to have to reduce rates. But if we don't, the economy is going to start gaining momentum again. And by the time we get to the second half of the year, I think that we'll see enough strength and pressure on prices that the Federal Reserve will start to reverse course and continue to raise rates.
Scott, what gives you confidence that that'll happen if we're not out of the woods yet? It seems like a sort of odd prediction that we'll be hiking later in the year.
Well, you know, first off, the volatility we've just lived through, a lot of investors were caught offside, just like long-term capital was back in 1998. That is not a sustainable position. And so ultimately, that is going to come to light somewhere in the near term if we have somebody out there in the shadow banking system who has a lot of exposure that they're offside on. But if not, the U.S. economy is still moving forward. With interest rates down, we're seeing housing pick up. The seasonal factors in January, the weather, the shutdown of the government are all going to be drags on first quarter output. And by the time we get into the second quarter, I think we're going to have a rebound from the first quarter. And a lot of the benefits of the reduced rates that we've had as a result of the pivot are going to play into the U.S. domestic growth equation.
Scott, the one scenario that you set out there about the potential for some kind of financial accident, a financial stress event that could lead to a rate cut. Do you actually see the makings of that? I mean, that's always, I guess, a disclaimer. You say, look, something could completely break loose in the markets. But right now, given levels of leverage and risk-taking and the conditions of the credit markets, do you see the setting as ripe for something like that right now?
Well, you know, that's a tough question to answer because where this sort of stuff comes from is typically opaque. And, you know, the one thing that policymakers did do in the wake of the financial crisis was that they pushed a lot of risk off into the shadow banking system. You know, for instance, not that I think CLOs will be a problem, but, you know, a lot of the bank loans today reside in securitizations. Again, I don't think that's the near-term problem, but we don't know what's hidden away from the eyes of regulators that could possibly come back to haunt us.